Cool. So I don't probably need to explain the SFDR, but we all know that it's been put into place since March 10, 2021, and is starting to get rougher and tougher. And we are running these different funds with these different strategies. And I remember when we started off and we were consulted to go, hey, you do an Article 8 fund, it's just easier for you guys to run it because you won't have to have such a high reporting burden with you. And I said, no, we're an impact fund. We cannot do an Article 8 fund because all of our investments are really impact first. And according to the definitions, we need to be an Article 9 fund. And we went on and did it. And my first question, maybe to Anna and Toba, your fundraising, how much do you believe that Article 9 is important in fundraising? And how do your LPs react to actually you being an Article 9 fund versus an Article 8 one? Maybe you want to pass the mic?
Yes. So I think there is no black and white. So it varies for different LPs, the importance, and it depends on their level of engagement, level of knowledge. And we see the major difference across different geographies. So definitely Europe is leading the way. We can see LPs who are interested in Article 9 funds and Article 9 funds only. This is their allocation. We see LPs who are curious, who are open, and we see LPs who are rather skeptical about this type of fund. So really, it's a spectrum. In Asia, they are rather at the stage of curiosity and openness. They are impressed with how advanced Europe is in general regarding the topics of ESG and impact. And for the US, it's maybe a bit less important. So it's not a US regulation, so they don't put emphasis on that.
So what you're raising globally, I guess, huh?
Yes, we're looking globally, yes.
Okay, good, perfect. Toba, what's your experience?
Many LPs have their own LPs, right? And they have a certain mandate for them to invest in impact. We in our venture strategy invest in impact companies, and we see that also as our USP, that we really understand what impact is, and we really identify opportunities of impactful companies. So basically, when you think about our investment strategy and whoever is attracted by that, then by impact and being compliant with Article 9. So I think it's definitely the reason for LPs to join us, but definitely also I think a trend that in the long run will just get even better in terms of more and more LPs with the interest of investing into impact.
Cool, thank you. Let's stay with you for a moment because let's look at the other side of the market. So winning over LPs is one part of our job. The other part is really winning over startups and founders to work with us as funds or investors. And we all know it's a competitive environment, while I believe the impact space is way more collaborative, and we just spoke about it before, than the typical VC space. But how much does it help winning over founders to kind of say, okay, we want you guys in as investors? So the exact fact being an SFDR 9 fund, not just being an impact fund, but SFDR 9, is that something that founders kind of ask for when you interact with them, or are they knowledgeable already, or do they not care?
I start?
Yes, please.
For us, it's still hard to say because it's early days, right? We haven't been around for that long. But so our N is quite small. But we did make the experience that it is actually a differentiator for impact startups. Impact startups are knowledgeable about what it means. And actually, there's a very good example with so the venture strategy of Trullenberg has announced a new investment just 2 days ago in Open Cosmos. They built satellites, microsatellites that they shoot into orbit, low Earth orbit, and then they sell the data, and then analytics applications can extract insights from this data for various different sustainability use cases. And here in this round, about a $50 million round, the founders were super keen on having a syndicate of co-leads that are all Article 9 funds, which at the end of the day also happened to be the case. At least there, I mean, we thought it is a competitive round, and this really helped us. Can I say what portion to that is, attributable to being Article 9 or really understanding impact? I don't know, but both is interconnected, right? If you do have to focus on, being Article 9 compliant, it also means that you have to have expertise in-house because it forces you to do that.
Cool, thank you very much. Now, let's cut to the chase. It's cool that we're doing this. I think it's the right orientation. It proves that we mean impact. But let's also admit that it's a lot of work to create these reports, to get the portfolio to report these figures, etc. The question really is, how high is that reporting burden? I'd love to ask Karsten, from his perspective, what he believes is really necessary to comply with the regulation and make all of this work.
So the regulation itself, so the burden to report, filling out the templates and so on, that's not a big difference between Article 8 and 9. So you basically try to have the same questions and so on, but for Article 9, your ambition level must be significantly higher, and you need to collect more data. The simple reason is that the EU framework, and don't shoot the messenger, they have invented this thing about 360-degree sustainability. So there are a lot of indicators that for Article 9 you need to take into account. So exposure to fossil fuels, gender pay gap, biodiversity of sensitive areas and so on, and stuff, data that you don't want to collect. But you have to collect them based if you're Article 9, and then the EU has this, I don't know if it's a more theoretical approach of targeting that for an Article 9 funds, all your investments need to be 360-degree sustainable. So that means you shouldn't have a large issue on gender pay gap. You shouldn't have a large issue on CO2. You shouldn't have a large issue on biodiversity. And that's very, very difficult to actually achieve. And that's why you said it by yourself. Article 8 itself is a bit easier because you can relax your requirements a bit. We will actually see how much the regulation adjusts to reality, because if we simply look outside, the world itself is not 360-degree ready already. And the question is, do we want to enable funds like you guys, or do we want to limit the scope of these Article 9 funds to a very, very narrow investment spectrum?
When Karsten and us prepared for this panel, I really had sweat on my forehead, because he did say something also about the gender pay gap as an example, and he said, Xavier, are you ready as a fund to equalize the gender pay gap in your portfolio companies in case you find out? Because that's actually what you would need to be doing as an SFDR 9 fund to be fully compliant. Is that still what you say? Or did I misunderstand you?
The question is, do you really need to equalize it or bring it to an acceptable level? So the key question about these indicators is that you go to a level where you don't have any red flags. I don't say you have to bring the gender pay gap up to 0, but you need to define a certain threshold that you still define as acceptable. And then if the gender pay gap within your portfolio company is like 15, 18, 20%, and the German average is, by the way, according to an international report by the World Economic Forum, about 18%, I don't think a company that has a gender pay gap of 18% is 360-degree sustainable. And then the question about Article 9 is, are you creating your positive impact based on an adverse impact in another area? And Article 9 itself, in its framework at the moment, so there's a revision going on, does basically say you have to level it out to a certain degree, which means you're transferring wealth from the investors into the employees.
I don't know how your LPs would react to that. I think currently we don't have that, let's say, general common understanding how to solve these problems, right? But they're there.
But it's actually okay, because there will be a revision of the framework. It's already in consultation already. There have been a couple of consultations. And I think in the end, the theoretical framework they developed itself, so if you go to Deloitte, you expect they provide you with a solid regulatory framework and tell you what to do. But I don't think in reality, if you really want to transfer this framework, that's okay. And we see especially smaller investors that they try to go along with the regulation. And I think actually that's okay. As long as you really target your portfolio on creating 100% an impact.
Great, thank you for providing that. And he's been a bit easier today than he was on the call. So let's see where we can tickle more from him. Anna, over to you again. This is already very complex in terms of the regulatory requirements, in terms of the reporting burden, etc. Now, you're working in a corporate VC within a very large corporation where complexity is probably a daily natural happening. How do you navigate having to be SFDR compliant within this entire kind of corporate environment that you're in with CSRD going on, etc., and still raise a fund at the right pace that you want to actually raise it and get to be impactful? Is that a complexity you need to navigate? And if yes, how do you do it?
So I have a very simple answer to this. The new fund is not going to be a corporate venture capital. It's an independent fund. So we will leave all that complexity and lack of speed behind, and we will accelerate and have more independence in our choices.
So you're not at all in the corporate environment of Eon anymore? Is it a real spin-off or?
Yes.
Okay. Well, congratulations then.
Thank you.
That makes things a little less complex. That's great. But like maybe you can still elaborate. I mean, you did take a choice to get out, but there was a CVC at Eon before, I guess. Was it SFDR compliant at all, or how did it work?
From what I know, I think it was an Article 8 fund, and it could be done. So actually, we are structuring all the regulation and all the policies for the new fund, also with the support from still Eon functions. So I think everything can be done if you have the right people willing to work with you and you're working together in a collaborative environment. Of course, I mean, corporates, the speed is completely different. But I think Article 9 is something that we're all still learning about. Even the reporting, when we see different funds have different KPIs, the structure is still evolving. It's not clear. So we're in a sense we're on a journey together in it, and it will have to somehow come to a certain level of standardization to move forward. Also, if you think of portfolio perspective, startups will have multiple investors, and every investor, when they come with different reporting structure, how do we make it manageable for a startup? Even with the best intentions, we will need to navigate all these situations. So the complexity will always be there, and challenges will always be there, independent of whether you're a corporate or independent.
Yeah, thank you. And I think it's opening up a market for a lot of AI software as a service companies that are trying to harmonize this for a lot of the different VC funds. But let's stay on that topic. And Toba, maybe you can give us like a hands-on explanation of how you guys deal with reporting burden. How do you come up with reportings? How do you communicate with your portfolio companies? How often do you call the founders and say, hey guys, we really need this information because otherwise we won't be compliant? And they're like Toba, I need to generate revenue. I'm worried about sales. Come on, take our reports and do whatever you can. Like, what's the day-to-day on creating these reports?
So there is not so much traction on the last part of what you said, given the size of our portfolio. And so far with the investments we have, I think we made a good job of making sure that in general, there is a big alignment before we invest. So we do have impact experts that do nothing else than understanding impact in general, but also all the concepts around it, the reporting. They make sure that we only invest in impactful companies before the investment. So they're also very much involved in the investment committees. They get in direct contact with the founders before we invest, have multiple sessions with them on all the impact topics. But then they are also involved after we invest. So in all the portfolio management, they stick around, they stay close, and make sure that we do have that alignment in the beginning, but then also we follow up with that after the investment. And so far, we do get what we want. It's not always perfect. As you also mentioned, some things are not really as you would call a green flag. There are things where they have to improve. But Article 9 also means that you can still work on that during the holding period. And as long as there is progress, you're fine, basically, right? But it also shows that there's a risk, right, of losing Article 9 certification in that sense, because and which is happening, right? A lot of funds are not Article 9 anymore, and they have been Article 9. So I think it's just having people that understand it very well, and also systems around it and processes, software. And yeah, we're lucky in our venture team. We have 2 full-time employees just doing impact. And then given that we have multiple asset strategies like private equity, we have 9 full-time employees in total. Obviously, they don't all work for the venture stuff, but there are scaling effects, right? Platform effects that we can work on.
Sounds like a luxurious setup. I'm kind of a little bit jealous. But like this entire work that you're putting in, one could argue that it's extra work versus a normal VC, right? Are you charging more management fee to your LPs for that?
Oh.
Why not?
Doesn't work, probably. Who wouldn't? No, I mean, for us, it's a differentiator. I mean, for us, the benefit is already that we can go out and, first of all, we're all passionate about investing in impact, right? It's why we're here. But second of all, that's also how we try to get funding, right? And I don't know why, especially during the current macro environment where everyone is, I think, also a bit struggling to raise something, or sizing down their initial fundraising targets.
Says the guy who's working for a company that raised 1.2 billion in 3 years.
Yeah, we cross multiple strategies as well, to be humble, right? But it's tough times. Probably we can charge at some point more for that. I also believe that there will be more and more Article 9 funds in the future, because LPs will demand it, I think. That's the trend where it's going to, because if you go back to the fundamentals of why we're doing all of this, then because we think that the startups that are compliant with all these rules and procedures, that they will be the resilient ones, right? That they will stay strong even though in market downturns and everything.
Go ahead.
Maybe if I can add a few words. We also, the way we think of it is, we believe that the most successful startups are going to be, from an investing standpoint, the ones who solve the biggest problems. The biggest problem we have right now is climate change and everything that comes along with it. So it's going to be super important to quantify how much impact they're making, and it's gonna, like, the returns will follow the impact. So we see it as an investment. So okay, we invest a bit, we need to put the work, develop the frameworks, how to calculate the impact, but then, like, we will get a super return on this. That's how we see it. And we don't plan to charge anything extra to LPs for being an Article 9 fund.
No, thanks for sharing that. And just to clarify, we don't either. Now,
why not?
Well, good question, right? I don't think the market understands, and much to what you were saying, like, if you come up with like a 2.5% management fee instead of 2, they're going to go like, why? Like, no. And then there's 10 others, 20 others that charge 1.7 or whatever else, right? So no, that it doesn't fly with the market. And we share the view that Anna just shared. We also believe it's an investment, it's a duty, it's something that's right. And to be very frank as well, if the fund works well, then everybody has their fair share anyway, or even more than that, right? So we believe it's an investment into the right topics, and we're not in this game just to earn carry. We're in this game to provide the impact and believe in these markets, right? So that's what unifies us. Cool, but let's kind of also cover the topics of greenwashing, because SFDR has been, as we know, misused by many people, many institutions, many investors, which have then been downgraded happily. And I think the entire regulatory body is also struggling with coming up with new factors so that this greenwashing does not happen. And that has put additional burden on the ones that mean it well, but has actually eradicated at least some of the players that have tried to use SFDR for the wrong reasons. Now, Carsten, where is SFDR going? I'm not going to challenge you on today's news, yeah? But maybe you can give the audience a little bit as to where you see the development, what that means, and how VCs and even PE players can react to that.
Yeah, absolutely. So one thing we shouldn't forget is how old the SFDR is. you actually talked about it applying on 10 March 2021, but it was developed back in 2019. So November 2019 was when it was released. So it's actually really, really old. And there is something like a misconfiguration inside there, and that is that in general it should be disclosure regulation. And now people have made it into a product categorization. So we're talking today about Article 6 funds, Article 8 funds, Article 9 funds, and that's not how the regulation itself is designed. In general, it should be, okay, you want to achieve something, disclose what you actually want to do. So the key idea that they are discussing at the moment is whether they get rid of these Article 8 and 9, they put them together, and you simply differentiate whether you have a sustainable investment approach or not, and how sustainable you are. So the entire regulation, when you look from SFDR over MiFID to CSRD and so on, has changed. It focused more on materiality, but the key design of the regulation is still from 2019. And when there was a large exercise by ESMA actually checking on what is greenwashing caused by. And when we think about all greenwashing, we say, okay, someone is overstating his actual performance. But today, in today's reality, sustainability has become a very bureaucratic and complex exercise. And a lot of greenwashing, that is, by the way, is subjective, is actually created because of a lack of knowledge and education. So people don't know how to follow the rules. They might not be able to pay the expensive consultants by Deloitte. And so that's a large thing, and I think the regulation is going a bit in towards getting a bit easier, reducing complexity, and focusing a bit more on material information instead of getting all the data from all the companies.
Great. And what's your recommendation for us investors? How shall we get ready for next level?
I think what's important is focus on your investment approach. So you should do what you're doing best, have a sound investment strategy. In the end, when I talk to end investors or clients, what I tell them is look in the actual companies a fund is investing, be it a large institutional fund by one of the large fund manager or private equity or venture capital. Look in the top 10, 15 investments, and you actually understand a lot more how the fund works than guiding through this 5-10 pages of disclosures. So my initial starting point, and you learn a lot more, is really look in the top 10 investments. And I think that's what you should also focus on. Find the right companies, create a sound investment approach, and then regulation should follow on your actual approach. And I think that's where the regulation is also heading to.
Cool. Thank you. Now, last question, and we can answer randomly. I believe that venture capital has a certain naivety that comes with it. We need to be naively optimistic about the future, although we try to rationalize a lot of the things that we take as decisions. However, this naivety is, I believe, very important in order to find the right outliers, find the right moonshots. Are we investors really ready for Article 9 funds? Are we really ready to take on all the regulatory burden? Or are we kind of walking naively into this trap and saying, hey, whatever is there, and what Carsten has been kind of also flagging to us in the preparatory calls and today again, like paying the gender pay gap, for example, in our portfolio companies, are we just saying, it's going to work out, regulatory bodies are going to adapt, we can discuss? Are we ignoring that fact? Or are we kind of getting ready for it? What do you think, Tova?
It's a very dynamic topic, right? Because as already said, there's a lot going on. There are a lot of changes, and hopefully these changes are positive for us, since we are already Article 9 compliance, and it is we don't want a way out, right? We want to stay in there. But yeah, I think in general, speaking about just what we see in the market, again, a lot of Article 9 funds are not Article 9 anymore. So yeah, I think that there was a significant part of the market that was naive. But also now with these, let's say, market corrections, I think there's also more understanding that it's not that easy. I wouldn't say it's impossible. So far, just looking at how we do it, having all these people in place and the processes, I mean, so far at least it's looking good, and at least I don't see why we should fail to comply in the next years. There's always a risk, and I think what's important is to stay up to date, to have these knowledgeable people. I've seen funds that were trying to do this with very low resources. I've seen investment professionals having two roles, like trying to cover impact and investments. I mean, I wouldn't see myself doing that because I'm already spending so much time just on analyzing companies and helping them. So yeah, there was naivety, very much so, and hopefully there will be less in the future.
Okay, cool. And Anna, how do you see it?
Yeah, I think we in venture capital, we are the pioneers and we are the shapers of the future, right? We are bold enough and courageous to go out there and to invest into companies that have the potential, let's say like Tesla or others, to kind of fundamentally change how the world around us works. So the way I look at this Article 9, it's an opportunity for us to also like shape how it's going to look like moving forward, to be this role model. Because as we said, like the rules and regulations, they are being revised. And I really liked what you said, that that the regulators should follow these best practices, these best investment strategies. So I see it as an opportunity for us to kind of set the stage for how it could unfold. And of course, I mean, venture is high risk business, right? So there's this risk always. That's part of the game.
I love how you smile when you answer that question. That's great. Okay, Karsten, maybe one last piece of advice on the naivety part. Do you think it's cool to stay naive or not?
No, I think in the end we shouldn't forget on what the actual regulation is targeted to. And when you look at it and you look in the 2018 documents, I know last century already, then one major thing is that we want to close the investment gap of 180 billion per year, right? Probably it's high already. And we shouldn't forget there's 180 billion per year is not created in a secondary market, so investors moving money around, but we have a primary investment gap in the primary market of 180 billion. And I think we need to actually create an environment in Europe that fosters to close this investment gap, because that's what we actually need, giving companies and employees and everybody the money to actually master the transformation and the transition to a sustainable but also low carbon economy.
Great, thank you very much. We have 2 minutes left. Are there questions for this panel regarding SFDR? There we go. Do you want anyone?
So in the previous panel, there was a comment that actually kind of the entire industry is sort of fighting against the regulations. So I was wondering, how would you evaluate the cooperation that's currently taking place? Because I think this would be a massive potential also towards harmonization and not every fund reinventing the wheel once again, but just joining efforts and saying we are all on the same mission, and actually we don't want to waste too many resources on the regulation, because this is not where the impact itself is being created. So what do you think about the cooperation and opportunities in the industry?
I didn't get all of it, but let's just see how much the overlap is, right? And then probably I just then pass around and we'll try to cover it. I think the SFDR is the best example of, trying to find a standard for everyone. But obviously in practice, there are nuances in every deal where there's room for interpretation. And even if you think about basic things like ESG, and we have a deal where we build a syndicate of different venture firms, and there may be Article 8 or Article 9 funds coming together. Each one has their own template, and they're going to the startup, asking them, hey, can you fill this out? And then the second one does the same. It looks totally different to some extent. Obviously, that's very unpractical. And at that stage, as a founder, I would also be not really amused. On the other hand, I want impact investors, but then it's just so much reporting burden. So what we try, for instance, is to align. and to make sure that there's one template, which is also, it's reflection, it's thinking about how we can make it better, and then also making sure that we reach out to the other investors and, in a friendly way, not tell them that our template is better, but just to find one way of working together that's easy for the company.
And Carsten, is there a collaboration body? If I wanted to influence SFDR in some way as an investor, what can I do?
You can try to go through the lobbying, like in German Bundesverband Alternativer Investments or BVI if you're a bit larger. But in general, I think the question that the regulators are also asking is, can we standardize it more? So create more standardized templates, maybe have more tick the box exercises and so on, because we need to reduce the complexity a bit to actually make it less of a bureaucratic exercise, but actually focus more on creating this transition. And that's the question, do we really need to differentiate between 6, 8, 9? Do we really need to collect hundreds of data? Do we really need to do all these kind of things? Or can it be a lot more standardized in the end? And I think that's what they are trying to achieve.